Dividend investing is a popular investment strategy that involves investing in stocks that pay dividends, which are regular payments made by a company to its shareholders. The idea behind dividend investing is that it provides investors with a regular income stream, as well as the potential for capital appreciation over time. So, does dividend investing work? I think it does. Dividend investing can be a successful investment strategy for many investors. Historically, dividend-paying stocks have outperformed non-dividend-paying stocks, providing investors with higher returns and lower volatility. In fact, according to a study by Ned Davis Research, dividend-paying stocks outperformed non-dividend-paying stocks by an average of 2.5% per year from 1972 to 2016. However, it's important to note that not all dividend-paying stocks are created equal. Some companies may have unsustainable dividend policies, which can lead to dividend cuts or suspensions in the future. Therefore, it's important to do your research and choose dividend-paying stocks that have a history of sustainable dividend payments and strong fundamentals. While investing in individual dividend-paying stocks can be a successful strategy, it can also be risky and time-consuming. Individual stocks carry a higher level of risk because the performance of one company can have a significant impact on your portfolio. Additionally, researching and monitoring individual stocks can require a lot of time and effort. This is where ETFs like SCHD, Schwab US Dividend Equity ETF, come in. ETFs are a type of investment fund that holds a diversified portfolio of stocks or other assets. By investing in an ETF like SCHD, investors can gain exposure to a diversified portfolio of high-quality US dividend-paying stocks in a single investment. There are several advantages to investing in an ETF like SCHD instead of buying individual stocks. Like ETFs provide diversification, which can help reduce risk. By holding a diversified portfolio of stocks, investors are less exposed to the risks associated with individual stocks. ETFs are typically less expensive than actively managed mutual funds. Actively managed funds are typically more expensive because they are managed by a professional fund manager who is actively buying and selling stocks in an attempt to beat the market. However, studies have shown that most actively managed funds underperform their benchmarks over the long term. ETFs like SCHD, on the other hand, are passively managed, which means they track a specific index and do not require a fund manager to actively buy and sell stocks. ETFs like SCHD are easy to buy and sell, and they can be held in a tax-advantaged account like an IRA or 401k. This makes them a convenient option for investors who want to build a diversified portfolio of dividend-paying stocks without the hassle of researching and monitoring individual stocks. Let's take a closer look at SCHD's holdings. The ETF invests in a diversified portfolio of high-quality US dividend-paying stocks. These are companies that have a competitive advantage and a strong financial position, which makes them less likely to cut or suspend their dividend payments. The ETF's top holdings include companies such as Texas Instruments, Lockheed Martin, PepsiCo, Inc. among others. SCHD's dividend yield is also impressive. As of March 2023, the ETF's dividend yield is around 3.3%, which is twice the dividend yield of the S&P 500. This means that investors in SCHD can earn a higher income compared to investing in the broader market. To put this into perspective, if an investor were to invest $100,000 in SCHD, they could potentially earn an annual dividend income of $2,800. In addition to its high dividend yield, SCHD's fees are low. The ETF has an expense ratio of just 0.06%, which is significantly lower than the average expense ratio for actively managed mutual funds. This means that investors can keep more of their returns, as they are not paying high fees to the fund manager. To put this into perspective, if an investor were to invest $100,000 in SCHD, they would only pay $60 per year in fees. SCHD's performance has also been impressive. Over the past 10 years, the ETF has outperformed the S&P 500 and many other high-yield blue-chip ETFs. This is largely due to the ETF's focus on quality companies with strong fundamentals. For example, over the past 10 years, SCHD has delivered an annualized return of around 12%, compared to the S&P 500's annualized return of around 10%. SCHD is also a great option for investors who want to simplify their portfolio. By investing in SCHD, investors can gain exposure to a diversified portfolio of high-quality US dividend-paying stocks in a single investment. This can be a great way to build a portfolio that generates income and has the potential for long-term growth. To illustrate the potential impact of investing in SCHD, Let's consider a hypothetical example. Suppose an investor starts investing $1,000 per month in SCHD at the age of 30 and continues to do so for 30 years. Assuming an average annual return of 8% and reinvesting all dividends, the investor could potentially accumulate a portfolio worth over $1.9 million by the age of 60. This calculation assumes that the investor does not withdraw any money from their portfolio and does not take into account any taxes or fees. SCHD is a great choice for investors who are looking for a high-yield blue-chip ETF to hold forever. The ETF's holdings are made up of high-quality US dividend-paying stocks, and its impressive dividend yield, low fees, strong performance, and simplicity make it a top choice for investors who want to build wealth over time. However, as with any investment, it's important to do your own research and consult with a financial advisor before making any investment decisions. So thank you guys for watching. And I will see you in my next video.